At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Try to work out what kind of investment approach you like. What's your investor personality? Because there's so many different styles out there, which you can broadly bucket into 3 or 4, which we try to do on our report. Because ideally, in our view, you want to find something that matches your personality. The reason that's important, if you don't, again, when you're losing money, you're going to be tested, and what we want to avoid is people jumping ship and changing tack, because that's a great way to destroy capital very quickly.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. There's a plethora of newsletters that claim to provide smart investment choices for our portfolios. But how do they stack up? Joining us today is Simon Shepherd, Principal and Senior Partner at Providence Advisory. G'day, Simon.
Hi, Phil. How are you going?
Good. Thanks for coming back.
Pleasure.
Simon's a seasoned financial advisor, planner and personal wealth coach. He's also the brains behind the Investment Newsletter Group, or TING, a project that is tracking the recommendations from leading investment newsletters. Now, we spoke before in March 2023, and I'll link to the previous episode for listeners to do the appropriate background checks on you. But run us through again what you're doing with Ting.
So really, Ting's a research or a screening tool for self-directed investors. And the main objective is to track a selection of recommendations from some of the big newsletter services out, mainly focused on the Australian market. And we've been running just over 2 years now with the original data set and list of services. So you might call it a finder.com for investment newsletters, perhaps.
Actually, I was looking at finder.com last night, and they've got a kind of a list of investment
newsletters. They do.
It doesn't stack up quite as well as you would.
It doesn't go as far as
No, it doesn't go. It's just kind of a review thing, isn't it?
Yes, exactly. Yeah.
This is something that I'm finding intriguing now. What is an investment newsletter? I mean, is that the correct term?
It's what we call it: research service, investment newsletter, stock pick tip sheet is perhaps more of an old-fashioned expression.
Yeah.
But basically, the objective of those, whatever you want to call it, those services is to help investors select investments. Usually, listed Australian shares is the core of most of the services that we look at. Yeah.
And they're usually subscription-based as well, aren't they?
Yes, pretty much. We're actually going to be adding one soon that's a different model, which if we get a chance, we'll have a chat about. But yeah, for the most part, they use a pays type approach.
Yeah. Okay, so you've got some milestones, or you're hitting your 2-year milestone. What are the milestones and what have you reached?
Yeah, so I think it's great we've just clocked over the 2-year mark. In terms of tracking 7 of the main newsletters, we started building what we call a virtual or a hypothetical paper portfolios back in 1 July 2021, and just clocked over the 2-year mark. So sometime in the next week or two, we will release the results and the rankings. So I think that's great news. The longer the data, I think the more reliable the information you can glean as a potential user or investor will be. So it's great to cross that 2-year milestone and see how things are tracking.
So which are the newsletters that you are tracking?
Yep, great question. So you can jump on our website, tinglive.com.au, and that's TING, which stands for the Investment Newsletter Group. But at the moment, the ones we're covering, Intelligent Investor, also known as the Eureka Group. It's sort of a subset of their broader service and newsletter. Stockopedia, Morningstar, Simply Wall Street, Motley Fool, Fat Profits, and a group called Wise Owl as well. So they're the 7 at the moment.
So you've introduced a medal system to make it easier to see who's beating the market.
Yeah.
And how it's performing. What's the medal system look like?
Well, the idea is just like a race or an Olympic competition, gold medal being the best performer. The way we categorize it with our ranking system is only one service or newsletter will ever get a gold medal. And that's hopefully one that's beating the market. So far, so good, and also beating all its competitors as well. So Gold medal goes to the top service or the top performing newsletter. And then silver would be, any service that's still doing a good job of beating the market, because at the end of the day, that's what we're here for, really. We're not doing this. Well, you may enjoy the investing piece, but ideally you want to be able to beat the market.
Earn a bit of
Otherwise,
dosh, yep.
That's right. Otherwise, why bother, right? And then the bronze star category really relates to, okay, well, they're maybe not beating the market, but at least achieving a positive return over the measurement period. In this case, 2 years. And so we just thought, try to keep it as clean and simple as possible. Some kind of, graphic, and the sort of the medal ranking seemed like a good idea.
Is it easy to compare apples with apples in the case? Because presumably they're going to have different styles and different ways of offering their services to consumers.
Yep. Look, we try to take a unified approach as best we can, but depending on the style of investing, they do all have different ways of recommending what to buy or what to sell. So we sort of adapt, or we start with a rule book where we try to build a portfolio of 12 stocks for each service. So the establishment approach or method is a little different depending on each service. And then once we've built the portfolios, we stick them in Sharesight, which is a great tracking website to see how they're going. And we've got all that data there in the history.
And so Sharesight just sort of spits out the numbers and says,
Exactly.
Well, this one is doing better than the other.
That's right. And that's what we feed into the website reports.
Mm-hmm. When you first started this, I remember the last time we spoke, it was a response to some of your clients as a financial planner wanting to have an idea of the best way to approach the market. Is that the case? Is that how?
Yeah, definitely part of it. Or also, in a weird kind of way, the clients that would come into our office and then realize that they wanted to try and do it themselves. And so we thought, well, what's another way we can help them to refine that process, to take some of the legwork and the heavy labor intensive, if you're doing it properly, the due diligence of the plethora of different services that are out there. So in a way, it's almost the antithesis, can I say that word properly, of like a full service investment planner. It's the rest of the people out there that want to have a go themselves. And that's a tool to help them, make that decision quicker, right? In an ideal world, it shouldn't be the only tool, but if it can just, independent analysis of a sample of those recommendations from some of those big high-profile newsletters, then we think that's a good service.
Does it also help investors to have these services to decide when to buy and sell, and rather than what to buy and sell? Because there's always that psychological element as well when the markets are going through one of their regular downturns that you really need your hand held.
I think the what's probably the priority. The point of a newsletter, I guess, or a service is let them do the work and the research and sort of ferret out what they like in terms of opportunities, investment opportunities. And in terms of the when, then I guess that's what you call the execution side. As you said, when do you buy, when do you sell, etc. And so the answer to that depends on the type of what I would call risk management approach you take, or rules approach, in terms of if things are going really well or if they're not going well, what action do you take? And if you want to completely outsource that, in other words, rely on the newsletter, then yes, the when is really important. If you've kind of got your own system, then the when is less important. So it just depends on the type of portfolio you're running and your risk management approach.
So there have been changes to the services covered and some removals and additions. Why was that?
Yeah, look, great question. What we've found over time through history is things never stay the same. So, for example, we actually started covering Lonsec for 12 months, and they're in a way a competitor to Morningstar. Very big, deep, well-researched investment house, not just direct shares, but managed funds. They supply a lot of financial planners with research. And, the portfolios were doing fine. And then just out of the blue, they cancelled the direct share service. So that's an example where the decision was made for us. Another service we were tracking, which is, still on the website, but will change soon, was a group called Stocks Down Under. And I'd probably describe them as more of a small cap focus. They changed their pricing model about 3 or 4 months ago and sort of wanted to push everyone onto a much more expensive service. So that was sort of the first, alarm bell for us, I guess. The other issue we had with Stocks Down Under, putting aside the performance, neither whatever, good nor bad, whatever it is, but the level or the amount of stocks that they recommended was not enough to, in our view, build a diversified portfolio. So if you were going to use their service, and they had some great calls, don't get me wrong, in our view, you would have probably had to subscribe to something else as well. So, they kind of, forced our hand a bit. We just didn't see value in paying the full fee for a limited amount of selections. And, let's hope they're making money for their subscribers. They seem pretty optimistic and believing in their product, which is great. So you should be. So yeah, from time to time that'll happen. And we always want to try to maintain at least a universe or a coverage of 7 newsletters. In that case, we swapped out Stocks Down Under for a group called Wiseowl. And that's, from time to time we'll have to do that. But hopefully, we want sort of a long-term stable coverage universe in inverted commas as best we can. But some things will be out of our control.
And is that one of the 2 that you've added to the list?
No. So Wiseowl is what we call a swap out. So good question. We managed to, again, jump in that time machine, inverted commas, and go back to 2 years ago and basically recreate the portfolios. And so it's as if we started on 1 July 2021. So that was, one of the great things about Wiseowl is they are very open and transparent with, what they own, what they've sold, etc. So that made it quite easy to go back and recreate the portfolio. So we've just been able to swap it out from Stocks Down Under.
And the 2 new ones?
So the 2 new ones that we are about to launch, they're very high profile actually, and both different styles. The first one is a group called Deep Data Analytics, and they're kind of, I guess, a macro, bottom up, top down type style. That's the way that Mathan describes it on his website. And then the other one is Marcus Today, again, very high profile. And, they're probably more of what I'd call a sort of a traditional stockbroking type. Lots of stories and color and less data driven like the Deep Data Analytics, more sort of a little bit gut feel, fundamental, some macro too that we're looking at. And part of the reason we selected those, again, the objective with Ting is to really try to have a good variety of styles and approaches. So hopefully, we pick up something for everybody in our service in terms of style.
So for new investors, it can be really hard because they see some of these services. And it's almost the question of where do you start?
Yeah, exactly. We're spoilt for choice.
Spoilt for choice, but with added confusion.
Indeed, maybe too much choice.
Yeah.
Look, I think the first thing is sort of take a step back and work out what your objectives are. Really important, I think, whether you
financial advisors always say that. And I think we've got that in the disclaimer as well.
Indeed. It's about beginning with the end in mind, right?
Yeah.
What are you in it for? Why are you doing this? Why are you trying to do it yourself? What's your time frame? All those kind of things are important.
And understanding that it is really difficult to beat the market.
Oh, absolutely. Yeah. It's very hard. And I think the biggest enemy per our last chat is the enemy within, right? The inner voice, the psychology. When things aren't going well, you'll be tested. And it's so important to have a robust process and be confident in it. So yeah, step 1 would be work out your objectives. Then step 2 is research the options that are out there. And hopefully tinglive.com.au can help you do that. It's a great starting point in our view, because we've done the work at least on a sample of returns. So you're not flying blind as to whether or not someone's going to make you money with their recommendations. And then step 3, again, which we talked about in the past, is really try to work out what kind of investment approach you like. What's your investor personality? Because there's so many different styles out there, which you can broadly bucket into 3 or 4, which we try to do on our report. Because ideally, in our view, you want to find something that matches your personality. The reason that's important, if you don't, again, when you're losing money, you're going to be tested. And what we want to avoid is people jumping ship and changing tack, because that's a great way to destroy capital very quickly and confidence as well. And probably the last piece would be, it's not, again, a little disclaimer, fine print on every report. Past returns aren't necessarily a guarantee of the future, but I think, it's certainly a good place to start. And the longer the data set and the history, and if that history is demonstrating continued outperformance or beating the market, that's probably a good place to start. But do more work from that point, of course, in terms of research.
Not only is it difficult to outperform the market, but it's even more difficult when you take into account the money that's outgoing to these services, and then a share side account, for example. You really have to factor these into your returns. And, it's okay, you might have the bulk of your money in an ETF or a managed fund or whatever, but it's really important to keep in mind that all those costs matter as well in your overall returns.
It does, absolutely. And I think it's a scale game. In other words, you want to have a minimum pot of money to play with so that those costs as a proportion of your investment capital are reasonably low. So if you would ask me to quantify that, I would think Not everybody can afford to do this, but probably $100,000 would be a good start. For better or worse, we just assume like an imaginary portfolio of 12 positions starting with $10,000 each. We figure that's kind of a good point that is enough size that those costs don't destroy your returns, but not so small as that it's not you're kind of wasting your time, etc. So yeah, and again, not indirectly, but a screening process for the services we use is cost is definitely a factor. Some services charge thousands of dollars a year, and probably on average, the ones that we cover would be in the $500 to $1,000 a year mark. So as a percentage of a $100,000 portfolio, you might be 0.5%, 1%. And if they can beat the market by 0.5 or 1%, there's your hurdle. Obviously, there's other costs as well, but you might have super as well. You might have your own investments or family trusts. So, again, it's a scale thing. The more you're multiplying out the benefit of those recommendations across multiple portfolios, then obviously you get more value as well.
Yeah, it's a proportional thing, isn't it?
Exactly. Yeah.
So tell us about the other developments and the Spotlight report.
Yeah, so we want to keep developing new ideas and providing more resources for potential subscribers to the newsletters. So we've launched a new product, I guess you call it a deep dive or a deep analysis of, the plan is to review each of the newsletters, and we call it a Spotlight report. And so what it is what we would think would be all the useful information that you want to know as a potential subscriber to a particular newsletter. And so on our website at the moment, on the media and research tab, you'll see a Spotlight report for Stockopedia, which is the first one that we've published. And I guess, again, not just returns, but what we're trying to do is ferret out across each newsletter what their points of difference might be, what sort of their, again, throwing around marketing terms here, unique value proposition, whatever it is. But the bottom line, what's their magic sauce? And so the idea, or one of the objectives with the Spotlight report, is to highlight that, as well as all the generic stuff. How many stocks do they cover? Do they do other things like ETFs, managed funds? What are the rough cost outlines, so on and so forth? So that you can quickly, again, without having to go through 10 different websites, just run this report and great, you've got it all there in front of you, ready to go. And that work's done for you. So over time, we plan to roll those out for each service, each newsletter.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
Let Staples Business Advantage use today's latest innovations plus our team's experience to make furnishing an office space easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
And it's interesting to go through that exercise anyway, just to read about what these newsletters are doing, because it's a valuable education in terms of the way they approach markets, and in turn that you can learn how to approach markets as well.
Yeah, that's right. And it gets back to that thing we talked about with the investor profiling or the investor personality type. The more you read and research that, the more you'll get a feel for what might resonate with you as an individual. Definitely.
Did you have any takeaways from the Spotlight on Stockopedia?
Not really. It's still early days. Obviously, in this case, the objective is to run it by the actual service as well before we publish it. So we give them the choice for input, and stressing that we are independent. So we won't. If they give us feedback, we don't always guarantee to reflect that in the report, because we want to remain independent and unbiased. But I guess another way of answering your question was we pretty much got an all clear from the team at Stockopedia. Couple of minor tweaks, so that that was good. That I think we're telegraphing the intent of what that service does, and that's what we'd like to do with all of the services over time. So again, saves you having to wade through 10 or 20 pages of marketing blurb on their websites, and there's a lot of stuff out there. It's great, but it's about filtering out the real information from the noise and the marketing blurb. And that's sort of one of the objectives of the Spotlight report, is to do that work for subscribers.
Get away from the sizzle, straight to the sausage.
Exactly. Exactly right.
And the reason why you're here today is as well because you've just released a quarterly report, the latest quarterly report. Tell us about that.
Yep, we're just ruled off on the June quarter. And a couple of shifts. The winner still, at this stage, the gold medal still held by Intelligent Investor for the 2-year track record. Still, beating the market by a comfortable margin. And then the silver medal still held by Stockopedia. So in other words, beating the market as well. The bronze medalist, we had one drop off. So at the moment, the only bronze medalist there, and again, to refresh everyone's memory, bronze is just some kind of positive return. So better than sticking your money in the bank or whatever, not losing money on paper. So at this stage, just Morningstar that are sitting there with a bronze medal. Previous chat or report run, we also had Simply Wall Street. But, not a major negative return. But again, in terms of our strict criteria for awarding medals, there's only 3 medal winners on the podium at the moment, so to speak. So again, time will tell. But that's the main change, I guess, in terms of the shift.
And that's no reason to discount or reject any one of the newsletters just based on a particular return over a particular quarter, is it?
No, exactly.
You've got to look at it in a wider context in terms of what you want to, as you said, what you want to achieve, whether the style of it. I mean, a lot of people like the Simply Wall Street interface.
Yes.
It's a very, very nice, clean interface as well.
Exactly right.
What do they call them? The snowdrops. That's right.
Yeah, snowflakes.
Snowflakes.
Exactly. Yeah, it's a clever approach. And so that kind of analysis, works well with people who are visual, and they're less about crunching the numbers or reading a 5-page stock report on why you should own the stock. So, yeah, the great thing about the Aussie market and the services, the newsletters that are out there really is something for everyone. So we are blessed with plenty of choice.
So do they focus on particular areas of the market? I mean, do some of them delve into the small and micro cap ends of markets?
Yeah, absolutely.
Because that's where there's a lot of interesting things happening and a lot of innovations.
Yes.
And volatility, of course.
Yeah, exactly. You take the good with the bad. So, and look, that's a great example. So WiseOwl which is the new service we sort of swapped out for stocks down under. Their focus is very much on small cap, which means that returns are more volatile. And obviously over time you hope they're outsized, in other words, beating the market. And I think there's common acceptance in the industry that investing in small caps does have more upside, because the simple reason that the big fund managers out there, it's not on their radar because the companies are so small. A fund manager, even if they like the story, they couldn't really accumulate a decent enough position to make it worth their while.
They're just too big.
That's right.
They've got too much.
That's right. And these are
too many funds to deploy.
Too many funds, too large. So that leaves unpicked opportunities, I guess, if you want to call that, inverted commas, or the diamonds in the rough, whatever sort of analogies. But so in a way, that's potentially an edge for the smaller investor, the DIY investor. And so just because WiseOwl at the moment hasn't been awarded a medal doesn't mean there may not be opportunities there. So again, the devil's in the detail with how you look at the data. And we're not here to stick the knife in or promote any particular. We want to a degree the numbers to do the talking, but also understand what's behind the numbers. So that's exactly right. And look, to a degree, they all cover less so the data-driven ones like a Stockopedia or a Simply Wall Street, but the more traditional ones, to a degree, they all cover small caps. But there are newsletters out there like WiseOwl that tend to be more focused on the small cap. So if you look at what they've got in their portfolio at the moment, or what we've got in our portfolio that tracks theirs, big predominance of rare earths, mining, biotech, small tech, all things that are really racy and in some degrees lottery tickets, right? You might make a 10 bagger or 100 bagger, but the other 9 or 10, you might lose 50%. So then it's not for everybody, right? It just depends on what, as I said, what your objectives are and what you can stomach in terms of volatility, things like that.
You're looking at a very, very small subset of available newsletters and available stock tipping kind of services. And there's many other different ways and there's trading ones as well. And listeners are being bombarded on social media with a lot of different ways of approaching the market. What would you suggest is a good way to help to filter out the ones that are not for you?
I suppose, like I said before, it's really figuring out what your objectives are and what type of investor you are.
Well, it is. I mean, that's it. But it's also to do, there's some that are promising incredible gains, aren't they?
Run away as fast as you can, mate. Seriously. It's just... Let me ask you this, put it another way. Why, if you had the goose that was laying the golden egg, why would you be selling the goose, right? If you had this amazing trading system that was just printing money all day long, why would you need to earn more money by selling it? It just doesn't make any sense. So it's really about questioning the logic of those systems. And it's interesting you mentioned that, because the quarterly newsletter from our head office, there was a piece on exactly what you just said. These AI driven, because obviously we're in an AI bubble at the moment, artificial intelligence, and promising these, incredible returns and a black box type trading system. But if it's too good to be true, it usually is. And every now and then I'll get the odd client seeing a newspaper ad for, amazing returns or these kind of things. And not once have I ever said, yes, you should invest in it. So yeah, there's no free lunch. There is no free lunch. You've got to do the work. You've got to put in the hard yards. You've got to ride the ups and downs. And the starting point is, what are your objectives and what's the best system for you to use? And go and do your homework. Never take it for granted.
We'll get back to the show right after this brief message. Why am I buying, holding, or selling a share? If you can't answer that basic question, then you don't have a plan. The best investors are ruthless in executing their plans. I've been fortunate to meet many great investors on the podcast. Tony Kynaston is one of the best. He has a clear and systematic approach to investing that is honest, sensible, and methodical. It's called QAV, Quality at Value. QAV now offer an excellent light plan for only $29 per month. You can follow their buy and sell recommendations and learn the ropes. And the first month is free using the promo code SFBLIGHT. Go to qavpodcast.com.au to sign up. That's qavpodcast.com.au using the promo code SFBLIGHT. Past performance is not a guarantee of future returns. Please read the QAV FSG and consult a financial professional before investing. I receive a small commission for services I recommend, and I only recommend services I use myself. And I think one of the key phrases you just mentioned is trading systems. And if you see the word trading or Forex, what are some of the other red flags?
Crypto is a big one, isn't it?
Of course, crypto.
It's the crowd favourite.
Yeah,
so,
that's
and
right.
look, yeah, it's a different kind of, it's funny you mention that, because in the long term, we may launch a similar review of those kind of things, what I call technical trading systems, where the only indicator that the service uses is price or the trend in price. A common system is called trend following or momentum, sort of another word for trend. But that's very different to what we're talking about now, where everything in our universe and the majority of the newsletters that we track, all of them, that what you would call fundamental analysis, right? They're looking at the qualities of an individual investment. And some may look at price as well as a method of refining when to buy or sell. And that's called technical analysis. But for the most part, this is good old-fashioned Warren Buffett style. What do you want to buy? Why do you like it? Where do you think the opportunity is? So on and so forth. Nothing to do with the price, or the price comes after that analysis. So, yeah, and, if those trading systems work as well, price-based, fantastic. But it's hard to track those, right? It's because it is very opaque. So there may be some out there that do work. But as I said, why would people be selling that? Why would they need to make money selling it if they're, supposed to be this amazing system that's already making money? Why would you give that away? So I'd be very cautious.
So this started partly because of your clients looking for ways to assess these particular investment newsletters. Have you had any feedback from any of your clients about using Ting?
Yeah, I think just how handy it is, and how the fact that it's independent, unbiased. It's not all things to all people, but it's certainly been a positive dialogue so far, positive feedback. Always demand for more information and more detail, but again, we're trying to balance out the resources, and you can't cover all bases. But
you're a very small operation. I'll just add here. We're not talking. You haven't got the office in Barangaroo and
that's right,
and the hundreds of support staff
with the harbour views and the barista coffee as you walk in, and the Google Workspace, whatever it is. Yeah, that'd be nice, wouldn't it, one day? But yeah, we're trying to, as I said, exactly right, just balance out the resources. But the feedback's been, it's great that there's an independent source of analysis out there, and just a selection tool to cut down on some of that legwork that you'd have to do otherwise.
Some of these services offer a model portfolio. What's a model portfolio, and how can it help you in terms of tracking what and when to buy?
Great question. So a model portfolio is really like an off-the-shelf basket, if you will, like a pre-packaged selection of shares, so that you don't have to figure out which ones to own. So in terms of the what question that you raised before, that's potentially a useful service for those people that just want to sort of walk in and pick up whatever 10 or 12 stocks. So some of the newsletters do that, some don't. Again, the plan is with our spotlight reports to cover off on if that is a product feature. And, ones that come to mind, actually, really good timing, the question, because the two services that we're about to add, Deep Data Analytics and Marcus Today, they both offer model portfolios. So that, pre-packaged, here's a basket that we like, buy them all or buy a selection or whatever. And so again, it takes the guesswork out of, or the homework out of having to do that. So that's the what piece taken care of by certain newsletters. Again, it depends on your personality and what, how hands-on and detailed and controlling you want to be versus how much you want to outsource.
Because the other side of it is filtering. Most of them offer a filtering option.
Yes.
And you want to be able to filter in certain terms. And if you're not an investment expert,
yeah,
you don't even know which filter to start with. But I think it's really important. One of the main filters is the company making money?
Yeah, good place to start.
That's a really good place to start, isn't it?
It is a good place to
because
start.
There's so many companies on the ASX that actually don't even make any money.
Exactly right. Yeah. And I think, the small cap space is, again, more, you have to be prepared to look at that blue sky, so to speak, right? So you're betting on the future of something turning around or having that growth. And so, again, certain services will have a lot more flexibility in terms of, I call it screening, filtering, whatever you want to call it. And you can tell the machine or the search engine, hey, I only want to look at, please return in my search all companies that have got a positive earnings per share. In other words, they're making money. And as you say, that'll cut out half the market, right? So again, it depends on how you want to approach it. But yeah, there's plenty of ways to slice it.
I think it's also worthwhile thinking about in terms of if you buy an ASX 200 or an ASX 300 ETF, how much is weighted to the banks and to the miners and so forth. And part of the investment journey is learning about which companies are better than others in the same space. So when you're putting together your own portfolio, you might want to own a bank, but why do you need all the banks? Or why do you need all the miners?
Yep.
And it might be a good way to start thinking about it and how to filter out and construct your own portfolio, but to get a little bit more diversification as well.
Yeah, well, that's right. So you could look at that two ways. You could start with the market or the ETF and then replicate it in your own way, as you say. So you're not going to own the big four. You're going to use whichever newsletter service to work out which of the banks do they prefer or which do I prefer, using their tools to screen those different characteristics that are important to me as an individual investor, whether that's a high return on equity or a low price to book and, whatever those measurement yardsticks are. So again, that's a good point. Or the other way you could do it is you could say, look, I'm going to take my $100,000 and I'm going to put half in the ETF. In other words, whatever the ASX 200 Vanguard Australian Shares, for example, or STW, same thing, tracks at 200, and say, I'm going to put half in the market and the other half I'm going to use whichever newsletter to try to beat that half that's in the market. So in a way, you've got your own mini coach or accountability coach there because you've got money in the market, and in a way it's a hedge as well. If you blow yourself up, probably not the right expression, let's hope nobody does, but if you have losses on the active part of your money, the other half is going to be hedged or insured. The fact that whatever the market returns, so it was nearly 15% the year just ended for Aussie shares, I'm going to earn that 15%. In a way, that's what they call sort of a core and satellite approach, where you've got your core exposure and then you build the satellites around that with discretion. So
and an automatic benchmark built in.
Exactly right. It's like an accountability buddy, right? Right there, because you can see the returns from the market. There's no lying to yourself in that case. And I mean that in the nicest possible way, but we're only human and we've got these subconscious biases when we invest, like we do with anything in life. So the more you can short circuit that stuff, the better. And that might be one way to do it, to have an ETF in your portfolio.
And of course, these newsletters don't offer any advice on position size as well.
That's so true. That's exactly right. And that's why, again, it comes down to doing as much work as you can, whether with an advisor or some profiling tools, whatever it is, on A, your investor type or your personality, and then B, some kind of risk management plan, which is, I think, crucial because, as we've said in various chats and today, it's not all the newsletters help that well with that part, and they don't necessarily purport to say that that's their job, but, that rule book's really important because you've got to be prepared for when things aren't going well. or when they're going really, really well, and then the greed takes over the logic. So, yeah, it's such a good point.
Okay, Simon, so tell us the name of the website again and how people can get in touch with you.
Sure, yep.
You've got no social media, I believe. What are you
doing
in this
Are you volunteering, Phil? You want to do my Facebook page for me?
I'm in trouble with my own.
Yeah, there we go. I'm lucky to post a photo of the family holiday to Cairns once a quarter, let alone anything. Who knows, one day. So yeah, website at this point, tinglive.com.au. So Ting,
T-I-N-G.
Yep. Ting stands for the Investment Newsletter Group. Tinglive, one word, .com.au. If you jump on the next week or two and subscribe, you'll get the benefit of the results for the 2 newsletters that we're going to be releasing shortly, because we've got some 1-year results for those coming up. So yeah, jump on it's free to subscribe. The reports go out quarterly. As I said, we're expanding. We're putting out spotlight reports for each service, adding 2 new newsletters. So we'll be up to 9, and, welcome any feedback. There's a comment section when you subscribe. So any suggestions, we're all ears. No guarantees, but we'll do our best.
Yeah, and presumably this is a great way to learn about investing, because you're asking the kind of questions that investors need to ask to get better investing.
Exactly. Yeah, and it gets them thinking about what is important and what are they looking for in a newsletter. Really important.
Okay, Simon, thank you very much for joining me again.
Thanks, Phil. Good to see you.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.